Hello, everyone, and welcome to this week's episode of the Weekly Tanker Market Podcast. I'm Trisha, your host, and today we'll be exploring the key trends shaping the tanker market for week 52. I'm thrilled to have Sandesh with us, our go-to expert on crude, CPP, and LPG markets. So let's dive right in.
Hi Trisha, thank you so much for having me here today.
Alright, Sandesh, so let's talk about the VLCC segment first. I heard the ex-MEG market started on a positive note last week with some optimism, but things didn't quite pick up as expected. So what do you think caused this market to lose that momentum?
That's a great observation, Trisha. The VLCC market in the ex-MEG region started with some positive signs last week. Private deals were reported and rates stayed relatively stable within a narrow range as the January loading window kicked off. Early week reports of the ship being held and that created a sense of optimism, and it's suggesting a potential tightening in tonnage, which could have driven rates higher. However, this optimism didn't last long. By last midweek, while rates showed a slight uptick, activity levels failed to gain substantial momentum. The weak sentiment persisted as the overall volume of inquiries remained insufficient, and that drive any meaningful improvement in the market conditions. Now, charterers continued to apply pressure on rates while owners resisted further declines, and it creates a tug of war that kept the market under strain. Now, despite some early promise, the fundamental supply-demand imbalance and it marked by steady tonnage availability and limited fresh cargoes. It means that the market could sustain any meaningful upward trajectory.
Thanks for that clear explanation, Sandesh. It definitely sounds like the market is really facing some tough challenges at the moment. Now, let's move on to the VLCC markets in ex-WAF and the ex-USGC regions. So, it seems like the ex-WAF started the week on a strong note, but quieted down later, while the ex-USG it faced mixed trends throughout. So, what's driving these movements in both the regions?
That's a good point. The VLCC market in the ex-WAP, that is West Africa, it started the last week on a positive note and rates rebounded as a post-Christmas cargo hit the market. It creates a temporary boost in the activity. So charters were busy covering January stems and that helped tighten tonnage briefly. However, as the holiday period continued for some part of the world, activity slowed down with the fresher inquiries, and this fresher inquiries was very few. At the same time, the available supply still met the demand and it keeping rates increase in the check. Meanwhile, on the ex-USGC side, the things were kind of a mixed. The US Gulf Coast to China route saw rates drop and it closed around $6.25 million lump sum basis, and the rates dropped by around $150,000. And we expect that further decline in coming future. So last midweek activity was slow with only one new fixture and it keeps rate flat last done levels. So for instance, if I have to say USGC, UKC stayed steady at $2.4 million on a lump sum basis. And by the end of the week, sentiments remained bearish due to limited cargoes and excess tonnage on the key routes. So in summary, while XSwap showed some early potential, the holiday season slowed progress and ex-USGC continued to facing headwinds with the weak demand and downward pressure on rates. Both regions needs more cargo to see a meaningful recovery in coming future.
So I guess we can say that both the regions were really struggling with the same core issues of low demand and abundant tonnage. Now, Sandesh, looking at the Suezmax segment, it seems like competition with the VLCCs is affecting the demand for these Suezmax vessels. So can you elaborate on how this is impacting the freight rates, especially in regions of ex-MEG and ex-WAF?
Absolutely. The Suezmax market across both ex-MEG, that is Middle East Gulf, and ex-WAF, that is West Africa regions, they has been under pressure and they were driven by limited activity and there were increasing competition from larger vessels like VLCC. So VLCC was in competition with Suezmax and it is keeping downward pressure on freight rates for Suezmax. So in XMEG, when we say that cargoes, there were a few fresh inquiries, but it resulted into the stable rates because the fresh inquiries were down, or we can say the very few in numbers, but overall the movement was very limited and the tonnage availability, it was also very steady and it has kept the market stagnant as charters continue to opt for VLCCs for longer voyage and it reduces the demand for Suezmax tonnage. And this is about MEG Gulf. So in WAF, the situation is even more challenging because the market saw further declines by the end of the last week. And weaker inquiries and growing oversupply of vessels, it kept rates under pressure and keeping downward pressure on rates. And despite we have seen some of the activities in the last midweek, but the overall sentiments for the entire week was bearish. We know that because of holiday season and the competition from larger vessels like VLCCs, it was a kind of a key factor driving down the demand and the rates as well. So to sum up, overall, both the regions were dealing with intense competition and oversupply of tonnage, and it continued to weigh on Suezmax rates. So until there is a shift in cargo volumes or we can say that a kind of a reduction in tonnage availability, rates will remain under pressure.
You're absolutely right, Sandesh. The steady availability of tonnage and the competition from VLCCs are definitely keeping the rates under pressure. And very true, until we see a shift in demand, the market is very likely to stay stagnant. So, lastly, let's touch on the Aframax segment as well. I see that both the MEG and the Southeast Asia regions it faced subdued activity and soft sentiment last week. So, could you share what are your thoughts on what's exactly holding the market back and what could potentially turn things around?
Well, the Aframax market in both the MEG and SCA region, that is Southeast Asia and Middle East Gulf region, they has been struggling with similar issue. One is low activity and second is weak sentiment. So talking about MEG, the market remains stagnant throughout the week while there is an ample supply of prompt tonnage and much of it well approved. I mean, that aligns with charter preference but hasn't led to any increased fixing activity. And in SCA, that is Southeast Asia, the rates declined slightly and it was driven by subdued activity again and similarly oversupply of vessels. So demand balance is keeping play in the both of the regions. So, but in SCA, while a few first decade January cargoes emerged, it wasn't enough to significantly impact the market, and tonnage availability remains robust for the natural fixing window. And additional inquiries for a second decade of January are crucial to restoring market balance. So, for both regions, like you have mentioned earlier, the oversupply of tonnage is a persistent issue. So, any recovery, if it has to be there, it will completely depend on either substantial uptick in cargo demand or we can say that external factors like weather delays or operational disruptions that could tighten the tonnage leads. So until then, the market is likely to remain under pressure with limited movements and soft undertones dominating the sentiment.
Exactly. Both regions are definitely dealing with an oversupply of tonnage, and that in turn is maintaining the pressures on the Aframax rates. So, Sandesh, let's also shift gears and focus on the CPP market. We've seen significant developments in China and India, with China optimizing its export routes while India is also seizing many opportunities. So, can you dive into how these shifts are impacting the CPP market globally and what effects can we expect moving forward?
Absolutely, Trisha. The CPP market has been shaped by a series of strategic moves from key players like China and India. And they have been significant in the global trade space. So, starting with China, if I have to give or if I have to explain the things, let me quote some stats here. China, they have issued 19 million metric ton of CPP export quotas for 2025, and it highlights its efforts to balance efficiency and competitiveness. So while overall quotas remain flat compared to 2024, China adjusted its composition by increasing the processing trade route by 29.3% to 5.95 million metric tons. And at the same time, they have reduced general trade route quotas by 9.4% to 13.05 million metric ton. So, this 19 million metric ton quota has been divided into two different part. One is processing general trade route and other one is processing trade route. So what is this? We can see later. But let me mention this. So this shift optimized export efficiency and it was particularly for the jet fuel because around 7.93 MMT jet fuel has been allocated. So this allows for bonded refueling at China's international airports and this reinforced China's dominance in the global CPP market, specifically for aviation fuel. So what does that mean? This means that this jet fuel of 7.93 million metric ton, it is also for export as well as for domestic consumption. But how this momentum will going ahead, it will completely depend upon the VAT because the VAT, it has reduction or the VAT percentage has reduced from 13% to 9%. And it was for all three top products like gasoline, gas oil and jet fuel. and it was specifically for exports because under general trade route, it has added cost pressures for traditional exports and it impacts margins. So on the other hand, India has capitalized on China's strategic rebalancing. So it is a kind of a game balancing situation. So when China reduce export, India increase exports, and by that play, India can get the momentum from the market in the space where they get China's reduced market space under their umbrella. So, if I have to say, India has positioned itself as a key player in a global CPP trade, and with high refinery utilization rates, and they were able to produce compliant fuels very fast because they have a kind of a good crude mix already in their hand, and their refinery runs more than 100%. That is, overutilization is kind of a trend in last 2 3 years. So if I have to give an example, in 2023 alone, India exported over 16 million metric ton of CPP, and it was just to Europe. Around India export around 52 to 53 million metric tons of exports, and you can say that around 25 to 30% was specifically to Europe. With China pulling back from certain segments, and this figure is expected to rise in the future, specifically in 2025 and even in 2026. You know, Trisha, in the market is also favorable for Europeans because if you can say that European trading firms, they are increasingly favoring Indian suppliers, and it was for their reliability. At the same time, they were competitive pricing and favorable credit terms. So all things were kind of a favorable for with respect to Indian suppliers. And additionally, India's focus on producing ultra low sulfur fuels, and those fuels those are aligned with the increasing global demand for environmentally compliant products, offering a significant edge in the market. So overall, the CPP market is experiencing a steady demand growth across key regions with the projections for a total requirement of around 122.7 million deadweight ton by 2026. And despite a gradual fleet expansion looming 4% supply demand gap by 2025, it points to challenges ahead because the supply is getting higher because of we have a significant order book now. And with the China optimizing its trade routes, India expanding its market share and geopolitical shifts impacting global dynamics, and the CPP market is set for an interesting evolution in the coming years.
Thanks, Sandesh. It's definitely fascinating to see how China and India are reshaping the CPP market. Now, with their strategic moves, the dynamics are definitely evolving quickly. So, given that, how do you see these developments affecting other regions like Europe and Middle East?
So it's really interesting to see how China and India are transforming the CPP market. With their respective strategic moves, the dynamics are shifting fast, and at the meanwhile, Russia has seen a change as well, with a boost in the demand from Latin America and Africa, and it drives a significant rise in sales. And it was about 18% in 2024, so that's massive. At the same time, China is also optimizing its processing trade route, and India is expanding its market share, which means Europe and the Middle East are having to adjust. Europe, for example, is looking towards India and the Middle East to fill the gaps left by the reduced Indian exports, and it's making the competition tougher as traders lean on the reliable and compliant suppliers like Indian refiners.
Thanks, Sandesh, for that CPP update. Now, can you also shed us some light on how is the LPG market performing?
Well, during the festive season, the east of Suez LPG market saw Indian utilities really stepping up, and it quoted a bunch of cargoes, and that impacted rates. They have dropped slightly from pre-Christmas levels, with AG Chiba now sitting in the high 50s per metric ton, down from the low 60s. So the holiday season has brought a lot of tonnage and making things a bit slower than usual. But there are still some cargoes left to be mixed once the holidays wrap up. So now looking ahead, we are expecting things to get busier as the new year kicks in and everyone gets back to the business. Now talking about west of Suez, it was also quiet with no fixtures reported at all because of holiday that we all know. So rates were around 113 per metric ton just before Christmas, but now there is barely any movement and we are expecting a big surge in activities after New Year. specifically in the second or third or decade cargoes. And since there are still plenty of uncovered cargoes waiting to be fixed, this quiet period is just temporary and we are gearing up for a lively start to 2025.
Thank you so much, Sandesh. It will be truly fascinating to see how these trends continue to evolve as we approach the new year and welcome 2025.
Thank you, Trisha, for inviting me. I would like to wish you a very happy new year to you, to our Saigal family, and to all our listeners who were kind of supported us since the start of this podcast. Thank you once again.
With that, we wrap up today's episode. Thank you so much, Sandesh, for all your valuable insights, and we definitely look forward to catching up soon to track these developments further. And as we close out to this year, we wanted to extend our warmest wishes to all our listeners for a happy and a prosperous new year. Thank you for your continued support. Wishing you all the best in the new year ahead. Until next time, navigate safely and stay informed.